I think we have 5.5 cuts priced in for 2024 in total between friends here. So, Bob, does this inflation report rhyme with the forward pricing?
I think it's going to be pretty tough for the Fed to swiftly shift to an easing position over the course of 24 in an environment where, each month you're basically seeing prints between 3 and 4% on core inflation, annualized rates. It's if the economy was slowing, right, rapidly, we were seeing growth, we were seeing negative payroll prints, things like that, I think they'd probably be able to have the cover to swiftly ease. But the combination of inflation a little too high and the overall economy growing around potential and the unemployment rate at secular lows, you add that all up, there's just not a good macroeconomic data driven case for why the Fed should be shifting towards a meaningful easing cycle, certainly on par with what's priced in. And the last thing I'd emphasize is I think people who look at the SEP and say, well, the Fed is likely to cut 3 times in 2024, they often forget to recognize that in that SEP, it also showed unemployment rising to 4.1%. And that's an important interplay, because what the Fed was saying there was, if growth slows, if the economy weakens, then inflation is low enough for us to do some maintenance cuts. But if inflation doesn't weaken and in fact ticks up, and the economy doesn't weaken in line with those expectations, it's not clear the Fed is going to deliver the cuts that everyone is expecting, and that's half the cuts that is priced into the market.
Hmm.